Hello and welcome to an FXTimes daily market recap. I'm your fundamental analyst, Nick Nassad. Today is Friday, January 29, 2010. We begin today's broadcast with a roundup of some positive U.S. fundamental data. Let's start with the U.S. GDP report, which showed that the economy ended 2009 on a pretty strong clip, with the economy expanding at a seasonally adjusted 5.7% annual rate between October and December. That follows a 2.2% annual rise in the third quarter. That was a pretty strong showing, and it was the best quarterly growth since late 2003. A big part of the gain did come from a buildup in inventory, and as we could see here, personal consumption was up 2%, which was smaller than we had seen in the third quarter. The housing sector rose for a second straight quarter, with residential fixed investment up 5.7%. Government spending increased a tepid 0.1%, but business spending rose 2.9%, which was the first increase since the spring of 2008. Overall, it was a pretty good report and helped to support the greenback in today's trading. A second report, the University of Michigan Consumer Sentiment Index for the full month of January came in at 74.4, which was up from the 72.8 we saw in the preliminary reading and the 72.5 which we had in December. The figure came in better than expected. Households were more certain about the current economy's health, but still cautious about the outlook. The current conditions index rose to 81.1, while the expectations index rose to 70.1. A third report, the Chicago PMI for the month of January, also saw a better than expected release as its index rose to 61.5. While new orders and the prices paid indexes rose, a big thing to take away from this report was the jump in the employment subindex, which rose to 59.8 from 51.2, a positive sign for the labor market. The Chicago PMI leads the ISM manufacturing index, and the positive report here should translate into a strong manufacturing report next week. The data this morning helped to push the euro-dollar pair in favor of the greenback as it broke below the 1.39 level, hitting a new fresh 6-month low in the pair. That accelerated the decline we've already seen in the euro for most of this week, as the euro has been pressured by concerns over Greece and its debt situation. The yield spread between the 10-year Greek government bonds and German bonds, which is the Eurozone standard bearer, had hit a record high earlier this week, and we also saw how the price to insure against Greek defaults was at a record high as well. These concerns are also now spreading to other peripheral countries in the Eurozone, such as Portugal and also even Spain. These problems are now likely to keep the ECB from moving to raise interest rates, and so it'll be a longer than anticipated time before they do such a move. That contrasts sharply with the expectations coming from the Fed, as in the middle of the week we had the Fed giving a bit of a rosier outlook of the U.S. economy, plus today's GDP data furthers the theme that the U.S. recovery is on track. Taking a look at the euro-Swiss franc pair, we see that we had a sharp slide in favor of the Swiss franc in today's trading as we hit the 1.4650 level. However, following the test of today's intraday low at 146.35, it seems clear that the Swiss National Bank thought that this level was low enough, or that the appreciation in the Swiss franc was too high, and so they intervened and bought the euro and sold the Swiss franc. So that explains this large spike here in the New York session. So the 1.4650 level should now be an important level to watch to see if the Central Bank of Switzerland decides to intervene further in the currency markets. That intervention had an impact on the US dollar Swiss franc pair as well, as it pushed above resistance at the 1.0550 level, reaching a high today at 1.0640. So that extends gains by the greenback that we had seen throughout this week. The pound dollar pair, which had been holding to an upward sloping line of support throughout most of this week, with the 1.61 level acting as support. Broke below that following the US GDP report as we had greenback strength. That broke us out of our sideways ranging trading we had throughout most of this week. So it seems that the US economy may be outperforming its rivals in the Eurozone and in the UK, and traders are now buying the greenback on the back of its economic recovery. So we're ending the week on a bout of greenback strength as expectations about Fed interest rate increases have moved up, while expectations on the ECB raising rates have moved further into the future. Now let's take a look at the upcoming fundamental docket for next week. From the US, we get data on manufacturing and services sectors in the form of the ISM PMIs that come out on Monday and Wednesday. We also get data on personal spending, on pending home sales, and in the second half of the week we get 3 labor market releases, including Wednesday's ADP employment change, Thursday's weekly jobless claims, and the Friday January non-farm payroll report. Around the world, we have 3 interest rate meetings. On Monday, we have Australia's RBA deciding on interest rates, and on Thursday, we have decisions from both the Bank of England and the European Central Bank. In the middle of the week, Australia, some other important releases to keep an eye out is Australia's trade balance, UK services and manufacturing, as well as Friday's Canada employment change. And that will wrap up our coverage of the Forex market for this week. For more news, videos, and analysis, please visit our site, FXTimes.com. I want to thank you for watching today's broadcast and wish you a great weekend.